markets. The traders at the New York Stock Exchange, CME Group, and the NYMEX. I'm going to start with Mark Newton on the floor of the New York Stock Exchange. You're our chart guy. You're always looking at trends, etc. But you tell me, this is our fourth win in a row if we close like this. And what does that mean for next week?
Well, it still looks like we could push a little bit higher. The trend is bullish, but we're starting to see a few signs that this rally might be a little long in the tooth. A few of the groups that have done well, like materials, home builders, are starting to show a few signs of stalling out and lagging. One thing I might point out is that the NDX and NASDAQ 100 is set to make a new weekly and potentially monthly closing high at the highest level in almost 11 years. So that's something where, you talk about the lost decade for investors where things have gone basically nowhere. The NASDAQ right now is certainly looking fairly bullish, but the other indices are not quite there. So we do see some divergence. The other important thing I might point out is that the euro, the movement this week has been pretty significant technically. It's broken out not only against the U.S. dollar, but also against the yen, against the Canadian dollar. So that looks like it could potentially continue into the G20 meeting. And we know that Draghi has gotten a little more supportive about the euro, and confidence is a little bit higher there across the board. But for the time being, this whole market is just plagued by what I call a crisis of confidence. Earnings have been mixed to disappointing. The economic news is getting a little bit better. But bottom line is what's happening in Europe is going to be a big overhang, I think, for the next 2 months.
All right. Well, no crisis today because the markets are higher, certainly, as we said, 4 in a row. Let me get to Alan at the NYMEX. We're looking at numbers that came out today about oil demand hitting a 15-year low, gasoline demand an 11-year low. We do have crude moving now below at $99 a barrel. So at this level, by the way, this is the aftermarket. We closed a bit higher than this. So that trend continuing today. What's going on with this?
Well, it seems like it's gyrating around the $100 level. We've got news events that are driving it higher and news events that are driving it lower. But fundamentally, because we have gasoline demand at 11-year low, it's going to put some pressure on crude oil, and we saw a lot of that today. We have a huge fundamental number and a technical number at $100. Both were crossed, giving the trade to get a chance to get short or to bring it down. And it looks like we've got some big support coming at the 97 level. If they start to work out things in Europe overnight, I think we may see it rally again out of here. So I think we're going to have a low of around $97 and then back up over 100 again.
Yeah, but that's a trading range we have seen about 37,000 times over the past 6 months. Let me get to Todd over at the Chicago Mercantile Exchange. We could talk about commodities. We could talk about equities. I don't know. Let me throw it to you. What should we be talking about on a day like today?
Hi, Liz. Thanks for having me. On a day like today, we should be looking for a market that's very dull right now, looking for a chance to, continue these moves. If you look at the commodities markets, they're mired in congestion here. They're not moving either up or down. They're just trading in between ranges. The stock market itself, the futures are now breaking out to new highs. But we're on low volume, low volatility. We're back into the tortoise rally of which we had in 09 and 10. So it looks like we're on that same pattern. And I look for the same thing to continue. I see no reason to want to try to short this market or sell it here.
No reason to short it. Yeah, that's the thing. Don't fight the tape. And we appreciate your perspective, all of you. Have a good weekend, guys. Thank you.
Thank you. Thank you.
How should U.S. investors react to the